Hello, everybody. Welcome to Friday. The S&P 500 was actually down 0.3% today. But again, luckily for us, we did better than that. The overall average rate of return across all of our accounts was actually up 0.3%, exactly the opposite of the market. Always fun when that happens, especially again, since we don't have, full exposure to the stock market. We often do better than the S&P when the market falls because we have, a big chunk of bonds that don't fall as fast. It's a lot harder to beat the market on the upside. I think one of the reasons that, we're doing that on a fairly regular basis is just because we've got the pieces in the market that everybody else seems to want at this point in time. The clean energy, the online retail, the big tech stocks, the innovative tech stocks, et cetera. So and the advanced healthcare actually, which did really well today too. So, we've got those components that are doing well. We have some broad market exposure ourselves. So, that's just part of our portfolio. It always has been. And, we just want to be happy right now that things are going really, really well for us. I'd like to talk a little bit about 2021. And this is really interesting for me. I was thinking about today. I cannot think of another year that has more things lined up like this year has lined up for possible good results. I mean, the combination of things I've just never seen before. We've had zero interest rates before, which is usually a good thing, and so that's here. But this situation with this pent up demand, where we saved a bunch of extra money last year, as a country, mainly probably couldn't spend it as much as we wanted, and the ability to have that come rushing out into the economy could be kind of fantastic. Vaccine has to work. So, that's going to be a big piece that we look at as far as that goes. And then you've got this scenario where they're putting out massive amounts of stimulus. And, what they're talking about in Congress is just one piece of what's being put out with the support from the Federal Reserve and the Treasury and whatnot. It's much bigger than it looks like. It's needed for the economy, I believe. It's needed for sections of the economy. It's needed for the unemployed, et cetera. But it's going to be like putting rocket fuel, in the rocket. This is the year I've never seen anything like it. Now, one of the things I always talk about is what I call the outside influence. These are the things that can happen. And last year was a classic example. We're marching along, all of a sudden there's a global virus. Wasn't exactly expected as far as that goes. So that can always happen. There's always this potential for something coming in from the outside. But I think if 2021, lays out the way that it could, I'd be surprised to see, it not do quite well. There are some pieces we have to watch for. Does the vaccine work? Okay, so, are there mutations or issues and things that we have to deal with there? Number two is, do interest rates go up enough to attract money away? The 10-year treasury is at 1.1% right now. It has grown from 0.7%. But that's not enough to attract money away from the stock market that's making so much. But you never know. That could get to be a higher number, and maybe it would. So we'll watch that. And then, the last thing that I really want to watch is kind of just the bubble. Can things get so crazy on the upside that things just, end up kind of selling off to get back down to something kind of normal? And that's a possibility too. So I am fairly optimistic with all of those pieces, but my outlook right now is that we're in a great spot. We've had a great year. It's just the beginning, and so we've already got a good start to the year, which I really like. But I do think it's really important to have some type of a down market strategy here with how much it's run so far. And so we had, I think, a pretty good down market strategy during the virus in February, March. We rotated out. We found things that didn't fall as much. Those types of things. I was very pleased with what happened there, and I really focused on that recovery, and it worked. And we outperformed the market, in the recovery by a lot, which I was very excited with. But when I look at what's happening here, this is why we're putting in these stop losses. And so, if I look back at previous bubbles, that's the strategy I think is the best way. Let your winners run. It's really important. Kind of let them come up, let them go, let them go. We'll watch them really closely, but then put in some little stop losses and just keep moving them up as those pieces continue to run. And I think that would be, a good strategy also. So we've got that in place. Again, stop losses are not, always perfect. There's all kinds of issues that can happen there. Got most of those stop losses in the IRA type accounts. I've got less in the non-IRA type accounts because of taxation, and I've had to move them farther away because I really don't want to create a big taxable event unless, things are really falling apart. It's better to have, some profits than watch them all disappear. So that's what we're looking at, for those catastrophic situations. So really exciting, great week, great year, great potential year, best potential year I have ever seen in my 35 years. I'll just say that flat out. Who knows what's going to happen, but in terms of the pieces that we all look at as professional, investors, wow, it's really amazing as far as that goes. And then now we've got some protection in place too, which I think is great. I will mention one thing, if you have friends or relatives or coworkers who are not maybe in the same position that you are, they're not capturing as much of the upside as we are. They don't have some type of a down market protection plan. Please, let them, know that we would be willing to talk to them and help them out if so desired. So I want to thank everybody very much. Great week. It was only 4 days, but it really, really was fun to watch, and look forward to talking to you next week. Thank you very much.